Sometimes the best trades appear when you least expect them, and sometimes the least expected trades turn to be the best trades. In this video, I will reveal a couple of trades. One of them was taken yesterday, this was a Dow Jones trade, and the other one was a DAX trade which was taken this morning. These two trades, they do tell a compelling story. The story of hedging a trade. The question is, did I enter in those two trades with the end goal in mind, or in other words, thinking that I will enter the second trade because I want to hedge the first trade? Well, the answer to this question is strictly no, but sometimes I do tend to end in two trades which are somehow negatively correlated, which gives me a great hedging opportunity. And these two trades are giving me exactly that. So what exactly is hedging? Hedging is a risk management practice or a strategy used by traders and investors to protect their positions from potential losses. It involves opening a second trade that offsets the risk of the first, essentially acting as an insurance policy against adverse market movements. Let's give an example to illustrate how this works in practice. Imagine you own a stock and you're expecting this stock to drop, or actually the value of the stock is already dropping. So what would you do to protect yourself? There are a couple of options. So you can either buy a put option, which gives you the right to sell at a set price, or the second option is to basically buy an uncorrelated asset class which is expected to move in the opposite direction of your underlying asset class or the stock that you are already worried it is dropping. Now, there are so many ways that you can hedge certain asset class. I won't be spending any time. I just wanted to mention a few because this is not the point of this video. So you have direct hedging, you have cross hedging, you have pairs hedging, you have futures hedging, you have options hedging, you have portfolio hedging, delta hedging, which is quite advanced. If you want to know a little bit more about hedging, there is plenty of stuff online, but I won't be spending too much time on the different types of hedging in this video. So let's have a look at those two examples that I took in the beginning of the video. Today, I'm going to show you those trades directly from Discord. This is the trading community that we have, all of the traders that are part of the day trading program. Here you can see the second trade that I mentioned this morning. This was a DAX trade, and currently the trade is now, it's giving me actually less than 11x. The price has come down a little bit, but that's not what I wanted to talk about today. The trade is still open. In correlation to these trades, I'm also running a different trade, which is Dow Jones trade. You can see here from this screenshot, I took the trade yesterday. I literally entered here, then I took some of the trade off the table when the price went to this level, and now I'm just letting those 200 contracts open. So this is a short trade. And the previous trade, as you've probably noticed, is a long trade. This is exactly what I wanted to walk you through today. So these are two very correlated instruments. So one of them is DAX and the other one is the Dow Jones. By correlated, I mean that if one of them is moving up, the other one is very likely going to move up as well. If DAX is going down, it's very likely the Dow Jones will go down as well, unless we're in some extreme market environment. Okay guys, so let's give a very concrete example. This will be, in our case, short Dow Jones and long DAX. And in this case, if let's say we are here, this is our DAX, let's write this down. So DAX, and then we have Dow, which is, I'll put this on top of it since it's a short trade. Even though those two instruments are not 100% correlated, meaning that if one is going up, the other one doesn't fall with 100% precision in the same direction, they're somehow correlated in most of the time. And about 80% of the time, when one moves up, the other one will follow as well. So by this trade that I entered yesterday, this was a short Dow Jones trade. The trade that I entered today, this is a long DAX trade. So if at some points there, don't forget that these are both risk-free trades at this point, because we've offloaded half of the trade already. So we're running a risk-free trade here, and we're running a risk-free trade down there as well. So Dow is risk and DAX is also a risk-free trade. So now if at some point, let's say, since they're correlated trades, if Dow, let's say, is going up, DAX is going up. At some point, if, let's say, this is our stop loss on Dow and this is our stop loss on DAX. Let's just write this down. So these are our stop losses. If at some point Dow comes here and hits the stop loss, and then DAX continues going higher. What we will end up with is one break-even trades and one trade that gives us a very high return. And this is in theory. I mean, in practice, we have different options. A lot of other things can go wrong, but in theory, in about 80% of the cases, this is what happens. So in this case, if one of our instruments gets stopped out, the expectation is that the other will compensate for the loss and may even generate additional profits. I've been trading this way for a long time, but there is an important distinction, guys. And this is that some traders intentionally set up hedging trades like this, while I don't. In my case, those trades are not pre-planned hedges. I take long or short positions, like in the example with the DAX and Dow from earlier in this video, which are basically solely based on my strategy. And if during that process another opportunity presents itself, perhaps in the opposite direction on a highly correlated instrument, I don't hesitate to take it. When this happens, it unintentionally creates a hedge position where in many cases, if one trade gets stopped out, the other breaks out. And the profit from that second trade can more than cover the loss. In certain cases, can double, triple, or even more than that, guys. Now, could you build a trading strategy based on this concept? Technically, yes, but I don't recommend it. And here is why. These instruments, first of all, aren't 100% correlated. And even if they were, factors like fees and commissions can eat the profits and make the setups unprofitable. The real value of this approach, guys, comes from when the hedging effect is a byproduct, not the goal. If you're following a well-defined trading strategy like mine, you're not placing trades to hedge, you're simply staying unbiased and letting the market dictate the direction. This neutrality, in a way, puts you in a position to profit in about 80% of the cases. Or in other words, if for instance, we are in a long trade and this will be on Dow and short trade on DAX, or the other way around. So we are in two opposite trades in a highly correlated instrument. Then in this case, at some point, if one gets stopped out, then the other one will just continue going higher, which might create, as I said earlier on, an environment for double or triple your profits. And of course, there is still risk that both trades can get stopped out, and that's part of the game. But when I say perfectly hedge, I mean that in some setups, even if both get stopped, my overall risk is controlled, unlike many who try to force hedging and end up losing on both sides.